Hello friends, welcome back to my channel. Today we'll see a very important topic in the financial landscape. Are the regulators in India in an overdrive mode? We have seen of late the RBI and also SEBI lately they have joined RBI in taking action against NBFCs and fintech companies. We have seen how they took action against the Paytm Payment Bank. Recently they have taken action against NBFCs like IIFL and others. So how these actions is going to impact the NBFC space? Will there be any positive impacts, or will it crumble the NBFC space in India? So we'll check everything about NBFC and these recent RBI actions in the video. My request will be to watch the video completely. It will be going to be very beneficial for you. You will have a complete knowledge on the topic. And if you like the video, please give it a thumbs up and share it with your colleagues. So let's get started. First, we'll see what is a non-banking financial company. So as per RBI Act, a non-banking financial company is a company registered under the Companies Act 1956. It is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authority, or other marketable securities of like leasing, hire purchase, insurance businesses, chit businesses. But it does not include any institution whose principal business is that of agriculture activity, industrial activity, purchase or sale of any goods other than securities, or providing any services and sale, purchase, construction of immovable property. There are some major NBFCs in India, for example, Bajaj Finserv, LIC Housing Finance, Muthoot Finance, Shriram Transport Finance, etc. So, but what is the difference between a bank and an NBFC? There are some major parameters, and we can see how bank and NBFCs are different based on these parameters. First, we'll see first parameter is banking license for operation. So to operate a bank, you need to have a banking license from RBI. But for NBFC, they offer banking services without a bank license. The bank is regulated by Banking Regulations Act and Reserve Bank of India Act, whereas the NBFC are regulated by Companies Act and Reserve Bank of India Act. The banks can issue demand drafts, whereas the NBFC cannot issue demand drafts. The banks are part of the payment system like NEFT, RTGS, etc. But NBFCs, they do not provide such services. CRR and SLR banks have to maintain mandatorily these ratios, whereas these ratios are not applicable to NBFCs. The banks, they create credit, but NBFCs cannot create credit. The eligibility for foreign investment in banks are up to 74% only, whereas the foreign FDI is allowed 100% in NBFCs. The banks can make checks payable to itself, whereas the NBFCs cannot make such checks. So I hope this difference is clear. Mainly, the main difference is that banks can accept demand deposit like savings, current accounts from the customers directly, whereas NBFCs, they can only take time deposits like and they issue debentures or non-convertible bonds for the public, and they gather their deposit, and both are into lending business. But the type of deposits they take make the difference between the NBFCs. So, like we discussed, NBFCs, they need to have money to lend. So from where they are getting money? The NBFCs are raising money by accepting non-checkable deposit, means non-demand deposit. So they take time deposits in the form of debentures, in the form of bonds, and then utilize that money to lend further to different institutions or customers. Also, they borrow money from other financial institutions, like they take money from the banks or other NBFCs and use that money for onward lending. Now, what are the types of NBFCs? There cannot be only one type of NBFC, right? So the RBI categorizes NBFC in terms of whether they take deposits or not, the activity they conduct, and their systematic importance. So there are many kind of NBFCs. We'll just mention a few here. The first is asset finance companies. You want to purchase a machinery or a vehicle or something, these will help you. Then investment companies. These companies invest into shares, equities. Then third type are loan companies. They give loans to individuals, the companies. Then there are infrastructure finance companies, like companies giving loans to for creating infrastructures like bridges, dams, roads. And then another type is mortgage guarantee companies. These companies, they take mortgages from the customers and lend money to those people. So now we'll move on to what action recently RBI and other regulators they have taken on the different NBFC companies. So first we'll see the action taken on IIFL. On March 4th, 2024, the RBI took action against the IIFL Finance Limited, a major NBFC in India. The RBI found main material supervisory concerns in IIFL's gold loan portfolio, including issues with how they first assessed the purity and weight of the gold during loan approvals and defaults. Second, maintained the loan to value ratio. Third, disbursed and collected loan amounts, excessive use of cash transactions beyond regulations they used, conducted loan options upon defaults, and how they applied charges to customer accounts. So as a whole, they found serious lapses in the whole assessment, administration, and this loan collection of gold loan portfolio of IIFL. They found serious lapses, and then they took action. These practices violated regulations and potentially harmed customers. So what action RBI has taken? First, they issued a cease and desist order. IIFL was directed to stop giving out new gold loans or selling existing ones immediately. Second, they asked them to focus on existing portfolio. They can continue servicing existing loans through regular collection and recovery processes. The RBI also ordered a special audit, which will be conducted to assess the situation further. The IIFL must address the issues identified in the audit and by RBI inspection for the restrictions to be lifted. This action aims to protect IIFL customers and ensure the companies adheres to regulations. So RBI has not stopped here. RBI has also noticed that if these cases can be with the NBFCs, they can also there can be also problems with the banks. So they have ordered a comprehensive audit of all banks' gold loan portfolio, because you have seen the gold is touching new highs. So you can get better value for your gold, and you can get good amount of money. And suppose if gold price corrects, then it will be difficult for banks to get the money back even through auctions. So RBI has asked banks to check their gold loan portfolio, check their loan to value ratio, and report back to it. Moving on, we'll see how what kind of action RBI conducted on JM Financial. On March 5th, the Reserve Bank of India took action against JM Financial Products Limited, a subsidiary of JM Financial. Here is a big breakdown of the situation. Reason for action. The RBI identified deficiencies in JM Financial's loan sanctioning processes for IPO financing and non-convertible debenture subscription. There were some specific concerns. They were repeatedly helping a group. RBI found that JMFL repeatedly provided loan to a specific group of customers to participate in various IPOs and NCD offerings. They also found lax credit underwriting. So the credit assessment process of these loans appeared to be superficial, insufficient margin. The loans were repeatedly granted against meager margins, meaning the collateral provided by the borrowers was not sufficient to cover potential losses. Now, what kind of action RBI has taken against them? First, the RBI directed JMFL to seize new loans immediately. They should stop financing and disbursing any new loans secured by shares and debentures, including IPO financing. This is a major step taken by RBI. They have also asked IIFL, JM Financial to maintain existing portfolio. JMFL can continue servicing existing loan accounts through the usual collection and recovery processes, but the whole portfolio will not be scrutinized thoroughly by RBI auditors. After the RBI action, SEBI also swung into action, and they took action on the JM Financial, the parent company of JM Financial Products Limited. Here is what SEBI found and how they responded. First, SEBI conducted an investigation. SEBI conducted an examination of a public issue of non-convertible debentures during 2023. This examination likely revealed some irregularity related to JM Financial's role as the lead manager for the issue. Allegations against JM Financial. What were the allegations? The SEBI suspected that JM Financial, along with its connected group entities, might have first assured exit to investors. That JM Financial promised certain investors a guaranteed profit upon exiting the NCD investment, which is illegal market manipulation. Second, they might have influenced subscription also. Like the JM Financial might have manipulated how subscription for the NCD offerings were managed, potentially to ensure a successful issuance. This could involve encouraging subscription through unfair means. So they have found that multiple applications from the same PANs were applied for, and later on those applications were rejected. But these applications inflated the subscription figures, and which attracted many retail investors to also apply for it. Now, what SEBI has ordered. Based on these allegations, SEBI issued an interim order against JM Financial. First, restriction on new mandates. SEBI barred JM Financial from accepting any new mandates to act as lead manager for public issuance of debt securities. They also provided them a grace period for existing mandates so that they can have a smooth transition for these projects, which are in their hand already, which they are managing. SEBI has also stated that they would complete their investigations into JM Financial's role in NCD issuance within 6 months. They have given a timeline also. That is a very good thing, so that the things will be clear in a time-bound manner. What will be the overall impact? SEBI's action aims to protect investors and uphold market integrity. It also sends a message to other financial institutions about the importance of adhering to regulations during public offerings. So, what will be the impact on NBFC space of these regulatory actions? The recent actions by regulators are likely to have multi-pronged impact on the NBFC space. So, we'll discuss about these. The first impact will be increased scrutiny and regulatory action. These high-profile cases will likely to increase scrutiny of NBFCs by regulators like RBI and SEBI. We can expect stricter enforcement of existing regulations and potentially new regulations to address identified loopholes. Second impact can be stricter lending practices. So NBFCs might become more cautious in their lending practices, particularly for riskier segments like gold loans or IPO financing. This could lead to tighter credit assessment, stricter loan-to-value ratios for collateral-based loans, and a greater focus on borrower credit worthiness. Third impact will be short-term liquidity issues. The freeze on new loans by IIFL and restrictions on JM Financial's loan disbursals could lead to short-term liquidity issues for these companies. They might need to rely on other sources of funding, potentially at higher cost. Reputational risk and investor confidence. These incidents can damage the reputation of NBFCs as a whole, potentially leading to decreased investor confidence in the sector. This could make it more expensive for the NBFCs to raise capital, impacting their ability to lend and grow. Fifth effect can be consolidation and increased compliance cost. Some smaller NBFCs might struggle to adapt to the stricter regulatory environment and may exit the market, leading to consolidation in the sector. The increased focus on compliance will likely result in the higher cost for NBFCs as they invest in stronger potential internal controls and risk management practices. So even the banks and the general public who were earlier investing in NBFCs, they will think now twice. So there will be an increased cost or the scarcity of funds. I can say for the NBFCs, because we never know when RBI or the regulators they can take action against the against which NBFCs they will take action against. But one good thing is that the regulators have made their mind very clear that they are not going to tolerate any kind of malpractices, and everybody has to follow the books. And so if regulators are clear in their thought process, everyone have to fall in line, including the NBFCs. So overall, there will be some positive outcomes also. So in the long run, these regulatory actions can have positive outcomes by strengthening corporate governance and risk management practices within NBFCs, protecting investors and promoting a more stable and transparent NBFC sector. So we have seen that RBI has controlled the NBFC sector, banking sectors, and it has managed to sail through many big global financial crises smoothly. And if RBI and SEBI they are taking actions, that will be in the overall benefit of the sector, and we hope that it will streamline the practices and the compliance in the sector, which will be beneficial for the sector and the investors alike. So thank you, friends. That was the video for today. I hope this video will be helpful to you. If you found this video useful, please hit the like button and subscribe to my channel. Until the next video, take care. Bye-bye.